13.2 Personal Income Tax. There's a bit of a narrative there that you can review. It talks about how income tax is spent. And then at the bottom shows a graphical representation of where money goes and how it's being spent. I don't know if this would apply this year because we've got a very different year than what we've had in the past. Okay, so when we're talking about personal income tax, there are 4 steps to determine income tax liability. Liability is what you owe. The way we compute that is we first, step 1, find the adjusted gross income, or AGI. Step 2, find the taxable income. Step 3, find the tax. And step 4, check to see if a refund is due or money is owed. Understanding that when you're making money and you're being paid by an employer, they withhold certain amounts. This withholding is all based upon estimates, so to speak, as to what you're going to end up, what your liability is going to be at the end of the year for the full years of work, and hopefully you've made enough payments so that that covers the liability. If you've made more payments than what you were supposed to have, then you get a refund. At the end of the year, you do, employers send out W-2 forms, so you as an individual will receive a W-2 form if you're working for someone. The W-2 form will show what was paid, the federal income tax is withheld, Social Security tax is withheld, Medicare tax is withheld, and other types of income such as interest, dividend, and self-employment income are shown on 1099 forms. To find your adjusted gross income, what you need to do is add the amounts on all W-2s and 1099 forms along with dividends, capital gains, unemployment compensation, and tips. You're going to take all those amounts of income, and then there are some allowed adjustments. And the example here is individual retirement accounts, IRAs, are adjusted out, and or alimony payments. So those are 2. There are many more, but this isn't a tax class. We're going to limit it to those 2 and to at least allow you to get the chance to compute what the AGI is. So an assistant manager at the Dollhouse, Jennifer Crum, earned $24,738.41. During the 9 months she worked last year, and $1,624.01 in interest from her credit union. So you'll see the W-2 and the 1099 forms. That must be on the next page, but we'll go ahead and take a look at it later. She had $1,500 in regular IRA contributions. So find her adjusted gross income. This is often referred to as AGI. So her adjusted gross income, we're simply going to take all that she made, $24,731.41 plus $1,624.01, and that adds up. That's going to be her gross wages, or gross income, I should say. And then from there, we're going to deduct the IRA contribution, or subtract that amount that she paid in an IRA. So she had $1,500 in regular IRA contributions. $24,731.41 plus $1,624.01 minus the $1,500 gives you $24,862.42. So her AGI, her adjusted gross income, is $24,862.41. Here's an example of her W-2 showing that in box 1 she made $24,738.41. Here's the 1099 INT that she received, and it's showing she earned $1,624.01 in interest. So those are the forms that you would use to determine what your income is. Now, after you've determined your AGI, the next step would be to figure out whether you have a standard deduction that you're going to be using, or if you're going to be using what are called itemized deductions. And these numbers are really outdated because there was, in 2018, there was a significant change to these numbers. But but the concept is the same. It's just the dollar amounts are different, and they change every year anyway. And usually every year they adjust by smaller amounts. But for 2018, there was very large adjustments made to this. So in this example here, for let's say this is 2017, the standard deduction was $6,300 for single taxpayers, $12,600 for married taxpayers filing jointly, $63 for married taxpayers filing separately, and $9,300 for head of household. After you find out your standard deduction, you would then figure out what your personal exemptions are. These again are for the year 2017 or even maybe 16. This has also changed dramatically in 2018. But a personal exemption would be yourself, the one that's being claimed. If you're married, you'll have two exemptions. And then you could add dependents. A dependent could be a child, a spouse, a parent, or other relative. And the number of exemptions does not depend on whether the filing status is single or married. The deduction for personal exemptions in this year was $4,050. This has actually gone down significantly since that year. The standard deduction went up, but the personal exemptions went down significantly. So what do we have then? A single individual with one exemption, 1 times 4,050. The exemption deduction is going to be 4,050. A married with 3 children, that's 2 plus 3 is 5 exemptions. It's going to be 5 times the 4050. Single head of household, single individual, head of household, 2 children. That's going to be a total of 3 exemptions. That would be 3 times 40,050. And so the way we come up with taxable income is we're first going to figure out what the adjusted gross income is. We're then going to deduct the standard deduction until we learn a little bit more about itemized. Let's just go with the standard. And then we deduct for exemptions. And then from there, you then can compute what your tax is. You'll get taxable income, and then from there you compute what your tax is. Okay, the easiest way to really kind of learn all this is let's just do it, come up with a couple. The tax rates here, oh, this is all 2016. Okay, so all the numbers we're looking at are 2016. Okay, so once you figure out what your taxable income, you have to determine whether you're single, married filing jointly, married filing separately, and or head of household. These are tables that you can use. And this is pretty similar to how we figured out payroll taxes, what you have to go through, but we'll figure it out just right now. We'll just kind of go through this. Let's go ahead and look at example number 2. Find the taxable income and income tax for each of the following. Herbert White, married filing jointly, 5 daughters, adjusted gross income is $48,300. Let's go ahead and just do that first. So $48,300 is the adjusted gross income. Herbert White had 1, 2, because it's married, plus 5, that's 7 exemptions. 7 exemptions. All right, so the way it's going to be computed, the taxable income, we're going to take the gross income, $48,300. There was no reference to any kind of contributions to an IRA, so we don't adjust it. We just come up with $48,300. That is the AGI. We'll subtract the standard deduction. This was on the previous page. The standard deduction for married filing jointly was $12,600. And then we'll subtract the dependents deductions or exemptions. Minus 7 times 4,050. The 4,050 was listed on the previous page as well. So 7 times 40,050. So when we run the computation on this, we should end up with a taxable income of $7,350. From there, we go ahead and use the tables. Married filing jointly, his range is 7,000 something, so that's going to be right in this, and that's going to be at 10%. So let's take the taxable income of $7,350. We're going to multiply it by just the straight 10% tax rate. And that means that he has a tax liability of $735. Onita Fields, single, no dependents, adjusted gross income is 28,400. 28,400. Okay, so single, no dependents. So single is going to help us understand how much the standard deduction is going to be. If you're single, your standard deduction is going to be 6,300. That's on the previous page. And then she only has one dependency exemption. So 1 times 40,050. So 28,400 minus 6,300 minus 4,050, because that's 1 times 4,050, gives her a taxable income of 18,050. We're then going to run to the single, and her range is, looks like it's right in here. It's 18,000 something, right? So we're going to take this. You can kind of remember how we did the payroll tables. This will be pretty similar. So it's going to be $927.50 plus 15% of anything over $92.75. $927.50 plus 15% of anything over $92.75. All right, we did that. She was at 18,050. So it's going to be $927.50 plus 15% of the amount over $92.75. Well, how do we come up with that? Well, we take the $18,050 and we subtract the $92.75. That's everything over 92. So the difference is going to give us what we need. So we're going to take this dollar amount, multiply it by 0.15, and then whatever the result of that is, we're going to add to that $927.50. That should give you $2,243.75. Let you go ahead and work on C and D. This is identifying that taxpayers have the option of either taking a standard deduction or an itemized deduction. The standard deduction is what it is, and what you're going to do is you're going to add up all your itemized deductions, and if that's larger than your standard, then you'll take the itemized. But if it's not as large as the standard, then you're just better off using the standard. Okay, so what are the kinds of things that you can list on your itemized deductions? Medical and dental expenses. But you've got to be careful because in 2017, it had to exceed 10% of your AGI. So you can see it's pretty tough to get that high, but sometimes when you have relatively high medical expenses, they can be deductible. Taxes, state and local taxes, real estate taxes, personal property taxes, those are all deductible. There are limits on that today, but 2016 there wasn't. Interest paid on debt such as home mortgage or student loans, they're deductible. Gifts to charities, qualified or such as a church or other nonprofit organizations. Casualty or theft losses, if you lose a vehicle or something, it has to be really high because it is subject to a very high percentage of your AGI as well. And this is what was in place in 2016, but for federal purposes, it's gone. Unreimbursed employee expenses, tax preparation, and other miscellaneous deductions. Those have to add up to greater than 2% of your AGI before they are deductible. That was then. Now for federal, none of it is deductible. Christina Kelly is single, has one child, and has an adjusted gross income of $58,700. Last year, she paid $3,240 in real estate taxes, $7,280 in home mortgage interest, and donated $1,200 to her church. Find her taxable income and her tax if she files head of household. So her itemized deductions, we're going to add together $3,240 plus $7,280 plus $1,200. The total here is $11,720. We're going to compare that to the standard deduction for she's single. So we're going to compare that to single. And for a single individual, the standard deduction is $6,300. So $11,720 is higher than 63, so we're going to go with her itemized deductions. All right, so $58,700 minus the itemized deductions of $11,720 minus 2 times 4,050, 2 exemptions times 40,050, and that gives her taxable income of $38,880. We now take that and look at the table. The table is single, so we'll look at our single tables. $38,880. Single, $38,000. So she's right here, right in that range. So she's going to pay $5,183.75 plus 25% of any amount over $37,650. Not much, but she has a little bit over that amount. So we've got to figure out what that is. $5,183.75 plus 25% of everything over $37,650. Well, how much of that is? It's going to be $38,880 minus the $37,650. That's going to give you what's over. And then that amount, whatever that is got to be multiplied by 25%. So 5183.75 plus this computation is going to give you $5,491.25. All right, so now we need to figure out whether or not there's a balance due or refund, and that's just a function as to how much has been withheld already and then the computations. Let's look at the example here. Jim Clark works at Petroleum Engineer for Chevron, where he helps in design deep, complex wells before being drilled offshore in Africa. His wife stays at home and takes care of their toddler. His salary last year was $123,500, and $1,210 was withheld from each monthly check. They file a joint return and use the standard deduction. Find the amount of income tax due to the IRS or amount overpaid as applicable. So let's take a look. The adjusted gross income, $123,500. We're going to subtract from that the standard deduction for married filing jointly. That was going to be $12,600. That's on the previous table that we've looked at. Personal exemptions, that's going to be $40,050 multiplied by the number of exemptions. Well, married, that's 2 plus 1 child, which was a toddler, which is 3. So 3 exemptions multiplied by 4,050. And that gives us a total of 12,150. So 123.5 minus 12,600 minus 12,150 gives us a taxable income of $98,750. So now we're going to take the $98,750 and go to the married filing joint table. Married filing jointly, let's see, 98,000. He's right in that tax bracket there. So the tax is going to be $10,367.50 plus 25% of any amount over $75,300. All right, so $10,367.50 plus 25% of the amount over $75,300. So what we're going to do is take $98,750, the taxable income, subtract from that the $75,300. That's going to equal what is over $75,300. And then we're going to take that amount and multiply it by 0.25. That is then going to be added to $10,367.50. So the total amount, $16,230. Now, he did have some withholding. I think the description or the problem says that he had $1,210 was withheld from each monthly paycheck, $1,210. So that's going to be $1,210 multiplied by 12. Have monthly checks, there's 12 months in a year. So we had a total of $14,520 withheld. Well, the tax computed is $16,230. He had $14,520 that was withheld on his paycheck. Looks like he ended up short. Looks like he was supposed to have $16,230 paid. He only had $14,520, so he has a balance due at the end of when he files his tax return of $1,710. I don't know if these even exist anymore, but There used to be 2016. I don't use them at all, so I wouldn't know for sure. But there's a 1040 easy that if you had certain criteria, if you met certain criteria, and here are the criteria list. There's 1 through 6. Pretty limited. I mean, most of you students would have qualified at that time to just use the 1040 easy. No adjustments to income. There's no itemize, and then your sources are just income and tax credits is all you're going to be using. And you're under age 65, and your income was not more than 100,000. There was a kind of a next level 1040A, which was a simpler form. You could then add some additional types of income that you could still use that form. Some tax credits you cannot itemize, and then your taxable income still has to be less than 100,000. All right, so Jennifer Crum is single and claims 1 exemption. Her income appears on a W-2 and 1099 forms on page 520. She contributes $1,500 to an IRA. Crum satisfies the requirements for the use of Form 1040A, but she must also fill out Schedule B, Form 1040A, since she has more than $1,500 in interest. Round figures to the nearest dollar. Okay, so what we'll do is we'll walk through the 1040A. That's going to be pretty straightforward. You list your name, the last name, your social security number, your address. There's an option to whether you want to contribute to a presidential election campaign, but doesn't mean you pay more. It's just whatever taxes you paid, whether or not you want some of them to go to this presidential election campaign fund. She marks her filing status as single, and then she identifies herself as being an exemption, and then adds, oh no, there's no dependents, so it's just one, straight down, just one exemption. And now we're going to add her wages from W-2s. If we go back to, I think it was 521, her W-2 showed $24,738. Her taxable interests on the 1099 forms are $1,624. So we're simply going to add this all up. She didn't have any other income, so we'll add that up, and she totals $26,362. She did have an IRA contribution deduction of $1,500, so we're going to adjust that. And we end up with the adjusted gross income. Total income minus the total adjustments gives her $24,862. We carry over from the previous page the $24,862. She uses the standard deduction of $6,300. She then qualifies for one exemption of $4,050, and then you have your taxable income. So you see this minus this gives you this, minus that gives you this. So based upon the tables, her tax is $1,713. So that's her total tax. And then, you know, if she qualified for any credits, they would be listed here, but it appears she did not. So what she still owes right now so far is $1,713. We look at her W-2, and it shows that she had withheld $3,276, which is going to work out good for her because she only owed $1,713. So we find the difference between the total payments of $3,276 and the total tax of $1,713. And because she overpaid, she's going to get $1,563 as a refund. Here's the Schedule B that shows the income from Employee Credit Union. If you looked at the 1099, that's what it shows. And she received $1,624. Okay, that takes care of 13.2.